Hello, everybody. Today, I'm going to look at the comparison of paying cash for a home and financing it with 80% of the value of the home, 20% down payment. Now, obviously, being in the mortgage industry, I'm a bit biased that financing is better, but I wanted to take as much of an unbiased view on this as I could and run an analysis to see which one actually comes out on top, cash versus financing. Now, this is not going into the whole conversation of strength of an offer. This is assuming that you're going to get the home no matter what route you go, which one is going to have more long-term benefit. So what we're going to look at, if I can go to the right screen, is a purchase of a $500,000 home. We're going to compare a cash buyer to a 20% down conventional buyer getting a 30-year fixed mortgage. If we look at mortgage rates today, or as of last Thursday on the Freddie Mac website, the average 30-year fixed mortgage rate is 6.06%. So we're going to use that as our comparison interest rate, or the comparison is zero because this person's paying cash. Now, they are bringing more than 500 to the table because there are closing costs. So we want to make sure we're capturing that. But obviously, there are closing costs on the mortgage as well. So this is giving us as close to an apples to apples comparison as we can get. Now, you'll see the payment is the same, and we're going to jump into why that is. But first of all, I want to explain what I'm doing here. Number one, we want to look at if you were to buy cash, what would you do at that point for reinvestment into your future? So reinvestment, in my mind, would be taking what you would not be paying on the mortgage and investing it somewhere. And if we click on more info, you guys can come in here as well. Come over to the reinvestment tab. You can see on the cash, we have an investment payment of $25.43.65. That is the difference of what this person would be paying in property taxes and homeowners insurance and PITI on the mortgage. So there's a difference of $25.43.65 every month between cash and borrowing. So we're just going to reinvest that. And this is basically the principal and interest payment on the mortgage, right? We're going to reinvest that into the S&P with an average rate of return of 10% as shown on this AI result. I've dove into this a bit. 10% does seem to be accurate before inflation. We're going to get into that in a second. But we're going to say they're going to invest $2,500 a month at 10% rate of return. The alternative is saving a boatload of money at closing, having your monthly payment go up. But now that you've saved all that money, we're going to take that, which is $381,000, and just lump sum put it into the S&P. Now, we're not getting into dollar cost averaging or anything like that. We're just going to lump sum, drop it in, and give it a 10% return and see what happens. So we've got a lump sum rate of return and a monthly payment rate of return. Which one comes out on top? We're going to look 15 years down the road. And right away, financing shows that you'll have a higher net worth in 15 years than if you were to pay cash, which is a very interesting result. Now, we do want to break it down a little further because this average S&P return of 10% is before inflation. Once we factor it in, the real return is closer to 7%. So it's probably worth adjusting this to match that 7%. So I'm going to do some stuff in the back end here. 7% rate of return instead of 10. How does that change our net worth? Now the tables are starting to flip, but it's still a pretty even match. So two different arguments for this. One, I think a lot of people, maybe the cash people don't think this way, but a lot of people like to have cash reserves after they buy a home, especially in the amount of 300-ish thousand, 381,000. It might be nice to have that money, but if you're buying a house for 500 cash, you probably have some other reserves, so it's not too big of a concern. But still, gives you more opportunity having that money on hand, if you ask me. Now, the other thing to keep in mind is any financial advisor worth their fee is comparing themselves against the S&P. And if they're not beating it by a decent margin, they're probably not going to be at their jobs very long. So it stands to reason that the people that are going to be doing something like this and reinvesting are actually going to work with a professional and not just dump it in the S&P. Yeah, the S&P is probably the safest investment you can make. Don't quote me on that. I'm not an advisor, but generally accepted, if everyone's comparing themselves against the S&P, it's probably a pretty good bet. But if you were to give it to an advisor, I think most of them would say they're going to get you 10% after inflation either way. So we can put this back to 10, and that's where your net worth is actually more by borrowing. Now, I totally just skewed the data with my opinion. You're going to have your own opinion. I think everybody is going to have their own, and none of us is right, none of us is wrong because we're predicting the future. But looking at the numbers this way, I thought it was interesting and worth exploring. So if you do have a buyer that's thinking cash is the only way, maybe show them this presentation. Maybe show them, hey, there is another option you should consider. Talk to your advisor and see what they think. They might have a very different opinion, right? Dave Ramsey does not like debt at all. He would say just pay cash and then live your life. The other side of the spectrum is get as much financing as you can because borrowing is cheap. So I thought it was interesting. I thought it would be fun to dive into that today. I hope you found it valuable. If you want to chat about this more, have any questions, let me know. Otherwise, have a great week. I'll talk to you later. Bye bye.